Well, do you?
I think this is the first time I've actually had a vacation and like thoroughly just enjoyed the vacation, not worked. Um, just took it off, and I was like, market's kind of boring. I'm just gonna take time off, and what do you know? And I missed a few things.
Yeah, just a bit. Some real creative. Hey, what do we say about the bond markets, Kirk? What's the rule on bond markets? What do they tell you?
Basically, the bond market. Who was it who said, was it Carville who said, is something along the lines of, when I die, I want to come back as the bond market because I can push everybody around.
I'm gonna
Um,
take a look at that. Hold on.
yeah, I don't know if he originated it, but he definitely said it, and it's true. It's true. I mean,
Yep, James
basically,
Carville. James Carville. Yep.
yeah. If you think about, if you think about the markets, everybody's interested in the stock market because, hey, we can make $1 billion overnight, investing in stocks, and um, the reality is all the smart people are in the bond market.
Mm-hmm.
The smartest people are in the bond market, and the stock market is what's sexy, but the bond market is really where the real money is. It's so much larger than the stock market. People don't realize that. And bonds are boring. Nobody wants to invest in bonds because they're boring, and they want to invest in the stocks because, hey, I made like 2% yesterday. Yeah, it's small thinking. But at the end of the day, for most people, stocks are probably still better. But in general, the really smart people invest in bonds. So just something to keep in mind. And a lot happened in the bond market. What happened in the bond market last week, Doug?
Oh, well, yeah. So bond yields surged to multi-decade highs. They triggered historic emergency intervention by the U.S. Treasury. And of course, that turbulent week finally spilled over in the equity markets. The Dow, S&P, NASDAQ all had tempered weekly losses, despite, and really tempered because it was a late Friday rally. And you could touch on this, why you never trade on Mondays and Fridays, or at least you better know what you're doing. Investors are looking at issues with higher expected deficits. It turns out that inflation might not be transient after all. Sticky inflation, a massive $40 trillion national debt milestone. We've got geopolitical friction with Iran. And by the way, it's Monday, it's August 24th. And, overnight, I haven't even looked at what the impact's going to be, but they were saying there was a massive amount of oil now finally coming out of the Strait of Hormuz. That's going to, have some impacts for sure. But I don't
I think I've heard that before, Doug.
Yeah, I've heard that before. I don't know the latest on the actuality and what that means and what triggered this latest. But here's what it means, and I'll we'll go back forth a little bit. We are entering a major danger zone this week, and it's prompted unexpected defensive actions from Washington. No surprise. I don't know. I think it's August 24th. We just said some primaries. There's something kind of major going on here in November that might be prompting some little more urgency from the from
Just a little bit.
Yeah, just a little bit. We had a 30-year yield spike surge to a 20-year high of 5.3%, which, by the way, for those panicking, it's still historically low. I mean, go back to the 80s when we were close to 20%, on these. But the problem for everyone listening is there's pros and cons. Historically, this is more in line with averages, but the negative of it is this is something that nobody really living today, whether they lived through it before, which a majority of investors have not. They've been just used to this frothy markets that no matter what happens, and frothy economy that no matter what happens, prompted by lots of M2 money. We've talked about that ad nauseum. But at the other side is even people that have been through it, memories are short. We see this all the time with every market, in economic situations, that people forget what they went through before. It's really interesting to see how they react and what they don't learn from history. So we've got a 20-year high of 5.3 on the 30. The 10-year Treasury hovered around 4.7. That means they're both high. That's really 4.7 is really high for the 10-year. And so in a surprise mid-August move, U.S. Treasury Secretary Scott Bessent doubled the volume of long end debt buybacks to at least $4 billion per auction, which forced borrowing costs down. So the market at first was happy with it. Yields fell temporarily on the news, but like so many things we've seen, especially with this administration, and it's not an indictment of the administration. It's a reality. If this administration just throws information out there, there's no filter. So there's a lot of reaction and then settlement that it's just the personality of the administration we have. So they fell temporarily, but again, they quickly rebounded. So fixed income traders are now going to start demanding higher compensation, which is called term premium, due to this massive government issuance and this $2 trillion annual deficit. And here's the thing to keep in mind. There's obviously correlation, causation. Mortgage rates. This is you've got to watch this. This mortgage lenders, the smart ones that know what they're doing, and I'll throw 95% of them under the bus, Kirk, because a lot of people in the mortgage industry don't understand mortgages themselves. It's just they frothily sell them. But the people that are actually what I call experts in it, they watch bond yields relentlessly, because bond yields are very highly correlated to mortgages. A lot of people are like, oh, the Fed, they raised rates, lower rates. Oh, mortgage. Yes, loosely correlated, but that is not where mortgage. That's why we can have, them, separate, and ultimately, they tend to trend together eventually. But it's those 30-year fixed mortgage rates have now scrambled back up to 6.64 over the weekend. So that's what we're coming into this Monday. That, again, we got to watch the mortgage market. This what's going on with housing is a real big concern. And there, when people are looking at, the relief to the housing market of being able to get transactions, we have I'm hearing news now, and again, it's very market specific, Kirk, where people are getting 0 showings. They're putting houses on the market and nobody's showing up at all. Now, there could be a lot of varieties for that. We still, I think, in the realtor market, there's always this, just optimism of like, hey, we're going to throw this out there and see what happens. And what's the word I'm looking for? This delay in actually, or disinterest in actually seeing what's really going on. But the housing market is completely locked, right? Those that are locked in at low interest rates don't want to move until they have to. And those that are locked in at high interest rates, were hoping at the time they bought it that rates might come back down, ultimately we are deadlocked. And if we're seeing the mortgage rate scaling back up to 6.64 and beyond, this is now becoming a very big concern, because especially for those locked in at higher interest rates, or the next generation trying to get into starter homes, seeing that we still have elevated housing because there's no supply, right? So demand still keeps that up, even though there's very few transactions at high interest rates. There's more to this. I'll turn it back to you because I got some other things that are key drivers going on right now. But, this has a lot of significant potential impact to the economy that needs to be watched very, very closely. And while there could be some short-term positives to what the Fed was trying to do, what happened with the rebound of the rate yields tells you the tremendous skepticism that's out there right now with what's going on with the bonds.
Yeah, it's. I have to say, being on vacation, a little behind in my updates, but I want to run through kind of like a lot of what's happened last week. And this always happens. I go on vacation, I come back, I'm like, what the F? And so I just want to kind of run through these really quick, just to kind of share with everybody what's actually happened in the past week. All right. So looking here at the S&P 500, as we can see here, I always do this. I always screw up the bottom of the chart. But if you look here in late July, the market's going sideways for a while since May, and in late July it popped up, right? Early August it popped up here, but it's really just kind of done nothing since. And so this is kind of the top end of the former range. As you can see here, we're kind of retesting that range, that along with the 20-day moving average. are kind of holding the market up, which is actually technically a good sign. It just means, I mean, you have to watch it. If it breaks down below, that's a bad sign. But for the moment, it's a good sign. It's retesting it. From here, it should go higher. And we got about a week left of August, and actually, we got 2 weeks left before Labor Day. What typically happens is, when we hit Labor Day, the markets tend to, let's say, go in a real direction, because Labor Day is when the professionals come back into the office. Typically in the summer in New York, people are in the Hamptons. In Boston, they're in the Cape. Like, people are on vacation. They're not in the office. Now, granted, they don't have to be in the office anymore because everybody's virtual, but most of them are on vacation. And then after Labor Day, the markets start to find a real footing. And I don't want to say they start to go higher, because that's not the truth of it. The truth is, when people come back in the office, they start to, they let the interns and the young guys and gals run things in the summer when no one's around. It's kind of like in a Santa Claus rally in the last week at the markets. It's just weird stuff tends to happen because you don't have like the cooler heads around. And so when that happens, it either means the market's going to start to go down or it's going to go up. Based on what I've seen the last week, it could go up. I was a little shocked. It didn't, this is one of those times I got to call myself out. It didn't, things, as you see some of the charts, some of the things didn't happen as I'd expect. But the S&P 500, this is actually, right in here is actually a good chance to pick up a position. I'd be really quick on the trigger to exit if it didn't, because if it goes below this line, that's actually bearish. So I'd just be very careful here. If you look here at the NASDAQ, it's gone nowhere in the last bunch of months. So I would not get excited about tech, as you'll see in a little bit. Tech is, there's actually some interesting opportunities. The Russell is still kind of going higher, but it's actually just kind of, this actually is not bullish, but it's really kind of riding this line here, which I didn't extend, but it's pretty interesting. So keep an eye on the Russell for opportunities there. I'm very interested in the Russell in general, especially with interest rates the way they are. Here's one that I got to call myself out on. I said gold wasn't going to do very much. Apparently, the gold market didn't get the memo, because the gold market just said, screw you guys, I'm going home. And it basically started to take off. I'm not expecting this. I'd actually be, I'll say cautiously optimistic. I'd be looking to potentially buy this. This is actually a really strong signal. But I'll just say this about the gold market. Okay, in the last, last month? It started to take off. Yeah, pretty much it's the beginning of the month, beginning of August, started to take off. So here's the thing. In recent markets, I mean, the last few years, I would look at this and say, oh my God, I got to jump on the bandwagon because it's going to take off. That is recent history. That is how I would look at this market. Doesn't make any sense, but I don't want to miss the train. Okay, that's the last few years how I would look at this chart. My historical context, meaning that I've been trading the gold market for 25 years and I understand it extremely well. I just happen to. It's one of those, sometimes you invest in things and it's your Moby Dick. It's just your white whale. It's just going to take you down every time. And there's some things you just know and you're good at. I happen to be good at precious metals, and this is befuddling me. I would not expect this. I wouldn't be surprised if this takes a digger at some point, but based on what's happened in the bond market, and just for reference, I've been on vacation, so I've been watching what's going on in the bond market, but I have not been following it closely. So I don't have as much feedback on it. I'll have some more next week, but in general, we'll go through the charts. So this is telling me that this is based on the bond market. And people are most likely going into gold because they're not liking what they're seeing in the bond market. And so they're rushing for gold safety. That's my gut. I'll know a little bit more next week, but I would not miss the ride at this point. It seems like the markets, maybe even international markets, I'll have to look, are just saying, you know what, gold, I love you. You're my best friend again, and let's get together. And I think that's probably what's going on, just based on how it's compared to other markets. However, the other thesis I have, which it could be that. So what typically happens is when interest rates are getting a little squirrely, it tends to be good for commodities. Now I'm going to share a chart here in a minute, and you'll see that maybe that is correct. So here's silver. Silver's kind of following along. Also a good sign that silver's coming along with it. If they were disconnected, I would say it's not a good sign, but because they're connected that way, that's actually a good sign for precious metals. Bitcoin.
Yeah, Kirk, I want to inject. Let's go backwards a year or so. Remember, there was a huge dissection between the performance of gold and silver for a long time. So, and we talked about that's kind of what would preempted that silver spike is we kept watching. Silver's not moving, but gold is. This time they are in lockstep to a degree, which is more normal and healthier. I mean, between the two metals.
Yeah, there's another chart, and I might bring it up when I hand it back to Doug here, so I can pull up a bunch of charts. And I'm a little waylaid just because I came back unprepared. So, but one of the charts that I look at as well is comparing gold to other foreign currencies. We live in the U.S. We do have some international listeners, but we live in the U.S. We only think of things in dollar terms. People internationally, maybe it's because for generations this has been the case. But I remember back in 2000, 99, 2000, when you go to Europe and there's change machines everywhere. They just change currencies because everyone's coming from different countries and they just all intermixed, and we're going to just change currencies. And now they got the euro, but that whole kind of mindset, people were just accustomed to different currencies and different things. The U.S., we just think there's nothing outside our borders. But if you're traveling, most people are just accustomed to this. So when you look at gold in different currencies, and I'll share those charts in a minute, how is it moving? Is it moving in the context of gold is going up in all currencies, or is it just going up in U.S. dollars? That's a signal for, and I haven't even looked at this, so I'll be very surprised live on air here what the result is. But if it's going up in all currencies, that's bullish. If it's just going up in the dollar, I would say it's probably because of what's going on in the bond market. That would be my thesis, but we'll find out in a few minutes. But Bitcoin's taken off, also probably because of the bond market, because that happened the last few days. Would not be surprised if that's the case. I'm in general, I'll believe Bitcoin when I see it. It just, I don't know. We'll see. But it looks like there's enough volume in there that's actually showing that some of the speculators are back. But we'll have to see. Ethereum the same. Here's what's going on in the dollar. Okay, so obviously, so the dollar was high. Basically, the dollar's been within this range of basically 100 to 97, or 96 and a half, whatever. So it's been in this range. It kind of popped out of the range. Now it's back in the range. People are like, oh my God, the dollar's falling. Listen, one of the things that you have to really watch if you want to know what's going on in the market, you have to watch bonds and the dollar. Who cares about stocks? I mean, we all care about stocks, but when you really want to know about the underpinnings of the market and the belly of the beast, if you will, of the market, just watch certain markets. So watch the dollar, right? Everyone, the government wants the dollar within this range. People are like, oh my God, the dollar's going down, the dollar's going up. Just watch, is it within this range or not? This is going to tell you if the market is healthy or not healthy. Because in many ways, the Bessent and the Trump administration are trying to accomplish certain things, and they're trying to make sure that the markets are quote unquote normal. Now, what happens if the dollar gets too high, it impacts foreign markets as well as the US, right? And you've got imports and exports, and they're trying to balance all this, by the way. I couldn't imagine being a Treasury Secretary. It sounds sounds interesting on the surface, but you really think about all the different things you've got to take care of, it's really complicated. So you've got to manage international markets because you don't want to blow up emerging markets or national markets when you're trying to negotiate trade deals. You don't want to blow them up. And so the dollar, they're trying to keep the dollar within this range. What they're also trying to do is they're also trying to manage the bonds. So here is T bonds. So this is 30 years. So you see here it kind of dropped down and then they supported it, but didn't do too much. And then you got the 10-year, which is really what everything's based on. So as you see here, there's a lot of volume come in the last few weeks with Treasury notes or the 10-year. As you see here, it kind of popped down. Bonds have been getting weaker, and this is the yield. I'm sorry, no, this is the price. So I always get confused when I don't look at the chart name.
Definitely not the yield if it's going down.
No, I know. I'm sorry, vacation brain. So this is the price, and a lot of people get confused because the price and the yield are inverted. So when the price is going down, it means the yields are going up. And sorry, I thought I pulled the other chart, the yield chart. But so basically, if you look here, it's been kind of bottoming out, and this is when the support came in. So basically, what the Treasury is saying is we're getting concerned, and so we're going to start buying bonds. This is what happened back after the global financial crisis. They started to basically buy bonds, and they did all these QE experiments for 10 years, was it? I don't even remember. Maybe it wasn't 10 years, but it was long. I think it was like 10 years. But basically, it had QE for a long time. And so what they started to do is they started to do what they call yield control or yield curve control. And so what they announced that they were going to start buying on the longer end bonds to keep it from taking off. I don't know if I approve of this solution or not, because they have a lot more data than I do. But on the surface, I'd be a little concerned. Because if you think about much of the Treasury's bonds are on the short end. A lot of it is on the short end, meaning like 30, 60, 90 days, 120 days, like short end. The long end is 30 years. Okay. Now, in a typical yield curve, what will happen is the short end yields are lower and the long end are higher. So you've got this yield curve that kind of slowly slopes and then flattens out as it goes out. That's a normal yield curve. Okay, I'll pull that up in a minute and show it. But in that normal yield curve, what typically happens is if it gets too wide, the financial institutions love it because they make this huge spread. If it gets inverted or it gets narrow, the banks hate it. But sometimes, depending on what they're trying to accomplish, the Fed and the Treasury combined, I'll call them the Fed, but it's basically both of them, will use control on the yield curve. So they might buy the long end, or they might buy the short end to keep things in basically in a manner that they want. The problem that everybody's crowing about is that the short end of the yield curve is getting bunched up. There's a lot of short end bonds out there, and there's a lot fewer long end bonds. So it's very easy for them to control the long end to push that down, but it's harder to do the short end. The problem that everybody's crowing about is the fact that, well, now you've got all this pressure on the short end. So what if short-term bonds take off? We're screwed because we can't control that. And the problem, and I think Janet Yellen should be drawn and quartered. The first female head of the Fed really screwed the pooch, and it's not because she's a woman; it's because she's an academic. And anyway, her politics aside, but basically, she had an opportunity to lock in for 30 years, 0% interest rates. I don't know what the 30 got to, but looking at this, the 30 got to, actually, this is the wrong chart, but the 30 got pretty low. They could have locked in 30-year bonds for most of the debt that was coming due and just pushed and punted out that yield problem for 30 years. No, she didn't. And she started doing what all the other Fed chairmen are doing, it's not just her, is they kept shortening bunching up the bonds in the short term. So rather than taking a 30-year bond that comes due and punting it back out 30 years, they just said, well, just keep it short term. I don't know if they have a plan for this, but I can guarantee you that if our entire amount of bonds that are issued are in 30-day paper, we're at the mercy of the markets. So if inflation takes off and we can't control it, interest rates go up from 4% up to like 8%, we're screwed. Our financial situation is totally screwed as a country. And withstanding Trump throwing a Hail Mary and doing the Mar-a-Lago Accords, which we've talked about in the show, which I don't know if that'll still happen, but it doesn't seem to be talked about, is unless something like that happens, we're screwed. Our country's finances are totally toast. And, gold, maybe this is the reason why gold's taken off. I know the gold bugs will tell you this is the reason, but they've been telling you that for 20 years. And I can guarantee you, anyone who's telling, any Chicken Littles out there are telling you the sky is falling, they've been telling it to you for like decades. I tend not to pay attention to those people. They might be right. And as I've said in the show, eventually they will be right. Eventually.
Clock's right twice a day.
Yeah, exactly. That is perfect, Doug. Yeah, broken clocks right twice a day. These people will eventually be right. And I know they'll be right because the math is the math and they are correct. The problem is that could be 50 years from now, and you could lose a lot of money in the next 50 years if you're listening to these clowns. So the challenge with all markets is everyone sounds really intelligent. They sound like they know what they're talking about. The world's ending and you need us, or else the world's going to end without you and you're not going to make all this money. Well, I can guarantee you if the world ends, I really don't give a shit about money because money's not going to mean anything. Neither is gold, right? If the zombie apocalypse happens, ammo, MREs, that's all that's going to matter. So I'm not worried about that scenario because you can't plan for that unless you're a prepper. And so rather than plan for that, I plan for things that are when the world is not ending. And that's how you should think about it, is plan for the world to not end. What are you going to do? It could be bad, but let's just say the world doesn't end. What are you going to do? Well, you're not going to put all your money in gold. That would be dumb. You can put a lot of money in gold. You could put a large percentage of it. And there are times, like last year we talked about in the show, we had a larger than normal percentage in precious metals because it made sense. This year it didn't, although it's looking a little good right now. But withstanding, the recency of the precious metals and Bitcoin and Ethereum, I would look at, all right, what are the markets getting disconnected? And if they do, look at what the Treasury did. The Treasury came in and intervened in the markets. What does that tell you? Okay, this is the real question to think about. Is the Treasury intervene? What does that tell you? It tells you that they're concerned. Okay, let's just walk through the thought process of this. Because I was on vacation, I was just looking at social media and some people posting, and people are going crazy. Oh my God, they intervened. And then a few days later, oh my God, the market didn't care. Okay, let's use this as a thought process for how to think about markets. Okay, rather than what does this mean? Because we all want to know what this means. Rather than what does this mean, let's walk through the thought process. Okay, try to figure this out. Okay, step one, the Treasury intervened and said, we're going to start buying in the long end. Okay, and basically yield curve control. We're going to buy in the long end and we're going to issue in the short end. It's basically what they've said. But what they came out and basically said is we're going to intervene in the markets. Okay, we're going to intervene. Why? Why are they intervening? That's a really important question, because if you just assume whatever it is, which is everything I've seen posted, which is people are assuming what's going on without actually, having any thought process whatsoever. They're assuming they know what's going on. The market's going to implode. Trump's blah, 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 blah. Oil prices, the Strait of Hormuz. Blah. No, just disregard all that crap. What does it actually mean? Okay, why are they intervening? Well, they're intervening, and you could look at this chart as a good example of why they're intervening. Why are they intervening? Well, there's this line in the sand here that if you look at the 30-year mortgage, it's right around 6.65. You know, the 15-year is right under 6. I'm trying to pull up a yield curve, but I'll do that later. If you're looking at, here it is. If you look at the 10-year, 4.7 right now. And it kind of spiked up a few days ago, and it's a little bit below the 4.75 is right where it just under, and then it came back. We're hitting a point where the 10-year is, it seems to be a line in the sand for the government. They don't want it to go higher than that. So you would intervene because you're getting a little concerned that the markets are out of your control. Now, the Fed and the Treasury, part of their job is to control the bond market. That's part of their charge, is to make sure that they're in control of it. They can't fully control it because the markets control it, but they have control over part of it. They have control over the short end through the Fed's funds rate. As you get out longer end, they have less control. Now, they can do some things to control, which is they do interventions like quantitative easing. They're buying back bonds and they're selling other bonds. So there are things they can do. The question is do they have control? So if the Fed announces, all right, we're going to start buying bonds, and the bond market says, screw you, we're going out, and the bond market does whatever it's going to do, and it completely ignores the Fed, that's a bad sign. Okay, so the Fed is intervening. Why? Because they're concerned. We don't necessarily know why they're concerned, but they are concerned about something. And when they came out and said that, the bond market reacted. And people were like, oh, we're going to front run the Fed again, just like we did before. And then a few days later, the bond market said, we don't believe you. We're going to do what we're going to do. And the Fed's like, oh, shit. This is how I'm reading behind the scenes stuff. Obviously, I don't know this, but the bond market didn't react to the Fed's announcement as you would expect. That's a bad sign. That's what market participants are concerned about. Because if you look back 10 years, 15 years ago, whenever it was 15 years ago, when we had QE, okay? When you had QE, 15, 20 years ago almost, when we had QE, the Fed was in control of the markets. The Fed was pushing the markets up. And what basically happened is the Fed said, we're going to buy bonds. And the market said, great, we're going to front run you. And that's how they're able to control the yield curve and push yields down, right? So we stopped doing that and we let the yields float a bunch of years ago. And it seems as though we're concerned about the bond market again, so they're going to start to push yields down. But the real market, the market participants, the free market said no. This is the biggest concern people have had in the last 20 years, is that the bond market does not follow what the Fed and the Treasury do. That is a real big concern for markets. This is what you should be watching for. Not is the Fed intervening, because the Fed intervenes, people front run and they make some money. And that tends to be bullish for the stock market, and it tends to be bullish for the bond market because they're trying to push prices down. The problem is if the bond market just says, we're not paying attention to you, we're doing what we're going to do, that's what everybody's been concerned about. I'm concerned about that. Not too much, because the Fed can really do a lot if they really wanted to, and they could do what they want to do. The question is, how much do they really want to do? And right now it seems like they're just putting their feelers in the water. Can we control the bond market and keep it from going any higher? If they really wanted to do stuff, they could intervene. Look at COVID. They came in and said, we're going to buy any paper we can. And the bond market said, okay. And they didn't buy anything. The Fed said they were going to buy high yield bonds. That's what they said. Did they buy any? No, they bought none, at least as far as I could tell. They bought none of them. But the market believed them. And so the high yield bonds were saved. That's all they have to do. But clearly they're dipping their toe in the water. They're not doing a cannonball in the pool. So I would watch the bond market. I would watch the bond market's reaction to Bessent's words or Warsh's words. I would see how the bond reacts to what they're saying. That would be what I would be watching. I wouldn't necessarily get too concerned yet or too giddy yet. I would just be a little cautious. Because if you look at the bond market, it's definitely reacted strongly in some ways. If you look at the dollar's definitely reacted strongly to that, which may be what their intention was. But if you look at if you look at the S&P, the S&P hasn't really done much, right? It's gone down a little bit. Okay, but it hasn't really moved in this. Okay, so the stock market's not really thinking about this at the moment. I would pay attention to it, but I wouldn't worry too much. If you look at gold's definitely reacted strongly to this. So that's something I would pay attention to. I wouldn't pay much attention to Bitcoin, Ethereum, because that's a little different. But people are initially worried, which is probably why it's gone up. If you look at bonds, crap, that's not what I wanted to do. All right, well, apparently that's the end of the this chart path. So I would look at other commodities, though. I would look at here we go. I would look at things like oil. Oil hasn't really budged that much; it's gone up a little bit. I would look at uranium. Uranium's come out of the cell a little bit, but it's still summer. Uranium's good going into the fall, typically. But here's commodities. All right, this is the DBC, so it's just basically a tracker for commodities. They've gone up. And this is actually one of those things that say, okay, commodities tend to do well as interest rates are going higher. So there's a correlation there, not necessarily a causation, but a correlation that you should be aware of. You should be aware of this. This is strong for commodities. This is agriculture. It's gone up in the last few days. So I would just be very aware of different markets right now. And I don't know if I would go all in because, 2 days or 3 days is not a trend, but I would definitely be paying attention to see, all right, are there opportunities here, and are the opportunities going to keep getting better? The Fed is not going to dip their toe in and then invest in. They're not going to dip their toe in and then just back off. This might be a ruse, but they're not going to back off. They're not going to change their tune. When they say something, it's the start of a trend, right? They don't just say, all right, I'm going to do this and then bluff. They don't typically do that. They make a statement and then start moving forward, and their progress tends to move forward. That tends to be what happens. So if the elephant feet are going to come into the market, as they're saying, then you want to be prepared for this. You want to be really prepared. I haven't read the news. I don't know when their actions are going to start, but I can tell you want to be prepared and you want to watch. What markets are taking off? Well, gold is certainly showing some signs. Commodities in general are showing some signs. I'd be paying attention to those things. The other markets, I haven't seen too much. I need to look at more charts, but I haven't seen a whole lot coming out of that news other than the bond market. And even that's not been impressive. The dollar, yes. Commodities, for sure. And actually, the dollar going down is typically inversely correlated with commodities going up. So that tends to happen. Maybe that's why. But in general, I would just be observant over the next few weeks of the market, because after Labor Day, we'll see what happens. But for the moment, I'd be very, very aware of what's going on, because a lot of big movements are happening in like gold in a very short period of time, as in crypto and the dollar. So what are your thoughts, Doug?
Sorry. So yeah, a lot of what you said, some coverage of that. So what are some of the drivers that I've seen in the news that's come up in the last week, and what's happening right now? First of all, and this is definitely something that stems from the last meeting of the Fed. If those have been listening or paid attention to the news, in the last meeting of the Fed, they elected to hold rates, and this was Warsh's first meeting as chair. They elected to hold rates stable. But it was the most contested meeting that they've seen in years. I think there was 4 or 5 on the board that were absolutely steadfast that they thought rates should go up. And they were outvoted, but this is one of the first times that the board has seen, some significant, differences of opinion there, which is very telling. So the problem, and what do we always say? Markets like predictability. But given what came last time, given the news that slipped out, markets have really been in a position of completely guessing. They're ditching forward guidance, and staying, because the Fed has ditched forward guidance and stayed tight-lipped. So now that we've got inflation stubbornly above the 2% target, there are more institutions like MUFG Research and Schroders that updated their forecast this week that now predict that the Fed will hold interest rates steady at that's 3.5% to 3.75% for the remainder of 2026, completely pushing rate cut expectations into 2027. And remember, one of the things, if those, again, watching the news and in the history here, they were expecting, or the Trump administration was expecting a favorable dovish partner per se in the Fed with Warsh's nomination that would be more of a rate cut type of advocate. But the problem is that he doesn't control everything, and the data continues to come back that is very anti-cut. It's very so I think pushing rate cut expectations of 2027. I would still argue that that's an aggressive. And what they're telling you is don't even think about it right now. We'll revisit that. Right now, just based on what they did, the best you can expect is that they hold steady. If we don't start getting more on the board that starts pushing to get those spiked, and ultimately, they could win, right? There's this new data. So what's going on right now? All the eyes are locked on the annual Jackson Hole Symposium in Wyoming. They are predicting, the analysts, that Warsh can no longer stay quiet. He's got to use his keynote debut to clarify his inflation strategy and calm these panicked bond investors. The markets need something to hold on to. We've got some energy shocks and a geopolitical D-Day. Crude prices ticked back up to $94 a barrel. That's following this continued escalating conflict with Iran. Secretary Bessent, again, not only talking about bonds, but also warned about oncoming economic D-Day for Tehran via aggressive sanctions. So more of this back forth. That stoked fears of an energy supply shock, fueling further long-term inflation expectations. Although over the weekend, and we don't really have the updates, there's been news coming out that there was a massive release of oil through the Hormuz. So we're going to see what that's going to do to start the week. Now you add more, to the market jitters, trade negotiation issues. I don't know if anybody was paying attention over the weekend. Washington and Ottawa were working on trying to negotiate down a proposed tariff that was put into effect last month, given 30 days to go into effect so there could be negotiations. At the last minute, Canada and the United States, pointing fingers at each other, walked away from the table. That means that the Canadian, 50% tariffs went into effect. Canada promised immediate reciprocal levies, triggering a slide in the Canadian dollar. And then you got Mexico stuck in the middle. So NAFTA, the North American Free Trade Agreement, certainly under tremendous pressure right now, which is, got a lot of jitter, creating jitters. Then, you look at traditional fixed income being this bonds, now there's this, where do we find this alternative for safe haven when fixed income has faltered? So alternative assets may be rallying because of that. Bitcoin may be rallying or benefiting from this high yield macro backdrop. But there's also another thing going on in the news. There's a pro crypto legislation push that's going on right now that might be getting some bullishness, jumping 6% to break past 77,000 for Bitcoin, which is its best week of the year. So here, again, not where I would say before, getting into a little more data, I would, one thing to think about with your capital in this whiplash environment, large asset managers are starting to advise investors to adjust allocations through specific risk mitigation steps, which includes avoiding long duration exposure, avoid locking cash into 30-year bonds right now because structural deficit spending could push those yields higher, degrading principal, potentially locking in shorter intermediate paper. Again, this is what's coming out from iShares and others. I'm not giving you advice right now, but this is the news that's kind of being, pushed out there by other investment shops. Target the belly, on this short to intermediate term paper, target the belly of the curve, 2 to 5 year notes. Yields are high, carry significant less price volatility if inflation spikes again. And then, going into structured bond ladders to stagger those maturities. That's some of the areas they're investing. I want to get back to gold and precious metals, though. A couple things happened over the weekend. Ray Dalio came out with a very public announcement that He warned from Bridgewater Associates, telling investors cut bond exposure and allocate 10 to 15% of their portfolios to gold to hedge against system-wide debasement trade. So, again, does that have a direct effect on it? But no, there was already this tension there. So when those types of things get put out there, that could just be the catalyst that makes it jump. So spot gold, right at the time, surged to a fresh 3-month high, breaching 4,700 per ounce. Silver jumped over 18% month to month to trade near 70 an ounce. So what he was looking at, what Dalio was looking at on the macro analysis of this debt, is that we got a 3-year deadline. He estimates the U.S. sovereign debt crisis will materialize within roughly 3 years if structural spending is not aggressively reined in. Debt service, the budget topped $432 billion in July alone. He pointed out that the U.S. is currently spending roughly 40% more than it brings in. And the government if it operated like a private business, the total debt obligations would equal roughly $11 trillion or 200% of annual revenue. And then again, you've got the devaluation of paper money. There's very little ability for Washington to significantly cut essential spending. He warned that the Federal Reserve will eventually be forced to print more money to buy up unwanted government debt. This mechanic directly devalues the fiat currency, making physical gold the ultimate, hard money store of value. And again, this is, and he's not typically been a gold bull. So, but he has a very public platform there. We've got, coinciding with that, we've got that treasury buyback shock with these escalated geopolitical conflicts. And while gold is capturing the headlines, I want to come back to silver. It has heavily outperformed on a relative percentage basis, reacting the same debasement fears, but it's also facing deep structural physical deficit. Compounding demand from artificial intelligence data centers. So now you've got the industrial side of it. Remember, silver has that demand that gold doesn't have. Massive global electrical grid modernizations and industrial electronics has been draining the global supply silver warehouses faster than mining companies can dig it up. Now, beyond Ray Dalio's warnings, the underlying combination of this structural bank buying, derivative short squeezes, deep physical supply deficit, that's driving a historic spike in these precious metals. So what do we have? We had a 289-ton surge that central banks purchased a massive amount in Q2 alone. We've got, according to HSBC and Reuters, international institutions are rebuilding holdings of large physical bars, specifically to insulate reserves from weaponized U.S. dollar sanctions. And then large asset managers noting that gold is increasingly being priced as a pure monetary asset rather than a commodity, because it's viewed as the only global reserve currency that carries zero counterparty default risk. So ultimately, we look at the shortage. We also, it's not spiking because of his warnings, obviously, but this acts as a high-profile media spark for a market already fundamentally primed to explode. When we got this de-dollarization fight, we've got sanction insulation, we've got a bond market trap. Ultimately, we also have an AI deficit for silver. All of these things are creating a soup of issues right now. And of course, Bitcoin also surged past 77,000 from structural and legal changes rather than this general economic panic. There has been some legislation pushes that are going through Washington right now. If people haven't been paying attention, they seem to be moving forward in establishing this U.S. strategic Bitcoin reserve. That's got I'm sure, some bullishness behind it. Wall Street spot ETFs have created this permanent liquid pipeline, allowing multi-billion-dollar pension retirement funds to seamlessly shift more into this. And the new Fed chair staying silent ultimately could be leading to capital fleeing traditional cash accounts, more speculation chasing high yield fixed income digital alternatives. Another thing I saw a report, Kirk, that's really interesting, is that they did a study. There was a study that went out that said that Gen Z specifically is starting to push more of their investments, or saying that they are going to start pushing more of their investments away from the traditional markets to sports gambling and other things like that, that tells you there is an absolute yield push out there, that is going on right now, where people are trying to get more return from speculation. And that, again, could be, something that's fueling this as well. Another thing is there's a massive paper to physical ratio issue. Historically, the volume of paper gold contracts traded on major exchanges outnumbered the actual physical gold held in those vaults by a ratio of 100 to 200 to 1. So we've got a highly leveraged fractional reserve system right now that creates massive vulnerability during an economic crisis. Wall Street traders buying gold futures have absolutely no intention of taking delivery of physical gold bar. They're simply speculating price movements, and contracts are historically settled in cash. So if even 5% of paper gold contract holders suddenly demanded the physical return of their metal at the same time, the exchanges would completely run out of gold, causing a systematic delivery failure. So we've got this institutional run on physical vaults. We've got an algorithmic option squeeze going on right now, and we've got a divergent pricing issue that all of this could create an extreme volatility in precious metals. Now, I want to come back, to crypto and Bitcoin for a second there to kind of round this out. So what's going on right, for those that aren't aware, Congress is aggressively advancing, a legislation called the Clarity Act. The Senate is scheduling a critical procedural floor vote September 15, 2026. So some of this movement could be bullish response to that. This would completely replace subjective regulatory enforcement by permanently classifying Bitcoin as a digital commodity. It officially would split oversight between the SEC and the CFTC, providing a multi-trillion-dollar pension funds with a legal green light to allocate capital into digital assets. We've got a Genius Act that's going. It's a bipartisan lawmaker that's passed this Genius Act. It's the first comprehensive federal framework for stablecoins that would codify a compliant dollar-pegged pipeline directly into decentralized rails that would stabilize underlying liquidity infrastructure of the entire asset class. And then following an executive order, which again can be reversed, they established a baseline reserve of 198,000 seized coins, and Congress introduced the American Reserve Modernization Act of 2026 that seeks to permanently codify the U.S. strategic Bitcoin reserve, mandating a strict 20-year lockup period and quarterly proof of reserve audits by the U.S. Treasury. Now, there's also some people that are arguing that this macro Bitcoin traction price action is tracking the historical 4-year halving cycle. They're saying, again, I'll call them the Bitcoin bros, are saying that it's following this uncanny algorithmic precision. I would argue that there's a lot of misrepresentation of that right now. It's not actually, if you really dig into it, tracking the historical halving perfectly. Flawless mathematical cycles are really, if any of you are hearing that, are factually inaccurate. Historically, Bitcoin never broke its previous cycle's all-time high before a halving occurred. However, in early 2024, Bitcoin completely shattered that rule by spiking to a new high months before the halving. Quantitative analysts have looked at this left translated cycle because they've anticipated the halving. They front-run the supply shock by flooding billions of dollars in spot ETFs early. This pulled the entire cycle forward, flattening out the traditional post-halving mega pump that people expected. And with over 19.7 million Bitcoins already mined out of the 21 million max supply, the mathematical impact of reducing daily rewards has shrunk to near insignificance. So the raw supply shocks are no longer large enough to move a multi-trillion-dollar asset on its own. The real driver here, I believe, it is truly a speculation to try to fight against global liquidity and the bond market. Bitcoin is no longer an isolated, esoteric digital asset operating on its own clock. It has become highly sensitive to macro liquidity sponge. Its current price action is tracking global money supply and bond yields far more than any internal mathematic code. So again, this legislative pivot is a real thing too. It's real fact. It's not a myth. this Clarity Act, this American Reserve Modernization Act. I think the movement that's going on right now in Bitcoin, gold, and silver, while slightly correlated, are actually fundamentally different things going on. Yes, we've clearly got this liquidity and bond market shift that I think is hitting all of them. But we also have the AI demand for silver going on. We have the debasement between paper and actual hard currency, gold, hard precious metals. And we also have this legislative push that I think is creating some bullishness there that, again, depending on what goes through Congress, and we know that there's a lot that can happen between, the Senate and the House, completely different fundamental philosophies because of, Senate tends to be much more aligned between the left and the right just because they have to get entire states to vote for senators. Housing can be much more, the House can be much more polarized. So just because it's moving doesn't mean that it's fact that it's going to go through. And if there's this bullishness, this belief that it's going to happen, and all of a sudden the carpet gets pulled out from underneath that, it could absolutely go the other direction. On top of that, I'll just end with this. Let's not forget midterm elections. Watch out for the next month or two.
Yeah, I think that's we're going to wrap it up here in a minute, but I did want to show these charts before we did because I promised I would. All right, so here is gold in relation to every other major currency. Here's gold compared to the yen, going up, good sign. Compared to the euro, going up, good sign. The this one is the British pound, good sign, going up. Canadian dollar going up, good sign. Australian dollar going up, good sign, and Swiss franc. So gold is going up compared to all these currencies. This is bullish for gold. Okay, this is the other signal, and I'm not surprised because gold kind of took off and the other currencies didn't. This is not a normal market, but gold went from basically 4,000 to what's it today, to 4,600 in a matter of a few weeks. So 15%, it's not bad in a short period of time, but just something to be aware of. When it's going up compared to all the other currencies, that's bullish for gold. I'd want to see that continue. I'm a little concerned that may reverse after Labor Day, but in the meantime, celebrating like everybody else. But in general, just be aware that's a signal you would look for. You'd look for how is this asset doing compared to all currencies, not just the dollar. Because it's the dollar, it could be just the dollar's going down, which the dollar did go down, and it could be the reason, but it's not because all other currencies. So any asset is in comparison to something else, typically currency. So you're buying an asset, could be Microsoft, could be gold, could be, baseball cards, doesn't matter. But you're comparing it to dollars. So you have dollars and you want a baseball card. So you're exchanging the dollars for the baseball card. It means the baseball card's worth more to you than the dollars. So if you see something going up in relationship, it means that, people are getting rid of their dollars and they're buying that asset. So this is bullish for gold. Just want to share that before we wrap it up here. Yeah, we want to take us home. Oh shit, we're a little late. You want to take us home here, Doug?
Yeah, and I'm not going to get into it now, but other thing, we'll talk a little bit more about this.
Let's just wrap up. We're well beyond.
Well, no, okay. This is part of the wrap up.
Yeah.
But my point is, just for those of you that want to do a little, go read up on lumber. Lumber is tends to be an macroeconomic canary in the coal mine, and lumber has really been softening into the summer. So that's something to watch too when we start to think about what's going to happen with the economy over the next in the next 6 months. But as we wrap up today, let's think about what the markets are telling us. Bond yields push towards multi-decade highs. Gold and silver are surging. Investors questioning government debt, inflation, currencies, even where the traditional safe assets are in the portfolio really are. Here's the temptation when the headlines get this loud. I got some messages over the weekend with Canada and America, and oh my gosh, here's the thing: the temptation is to react, to buy the thing that's going up, to sell the thing everybody hates, to predict what's happening next. If you are approaching retirement, there's a better question. If any of these things goes badly, does it actually change your life? If rates stay high, are you okay? If inflation sticks around, are you okay? If the markets fall just as you retire, where does your paycheck come from? Taxes rise. One spouse lives to 95, or one Social Security check eventually disappears. Does the plan still work? At this stage in life, the goal isn't to win every market prediction. It's to build enough structure you don't have to. At Emergent Advisors, that's what we help families do. Coordinate retirement, income, investments, taxes, college funding, and the rest of the financial lives so they can spend less time reacting and more time living. And if that little internal voice has been asking, are we really going to be okay? That's probably a question worth answering. Visit mergentadvisors.net. We're going to be rolling out a new website here shortly with some new things, so good to check up on that. Mergent is MERGENT, MERGENT, mergentadvisors.net. The goal isn't to just retire from work, it's to retire from worrying.
Awesome. Well, appreciate it, Doug. And that's the show for this week. Thanks again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. We do share a lot of charts in the show. So if you're looking for charts and show notes, check out our show at moneytreepodcast.com. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling you products or services, so do not consider this advice. If you're seeking financial advice, give us a call. We take clients selectively, but only if we like you. So if it so happens we don't like you, there are plenty of advisors out there who work with anybody with a heartbeat and two nickels to rub together. But like I said, we're selective. So give us a call and find out. Have a great week ahead. And remember, no one will care about your money like you do. So invest in your life.